poor reform record and a refusal to cut subsidies and manage deficit. It is not clear if even the combined might of RBI and rating agencies is enough to push the government into hard action. In Mumbai with Arvind Sukumar, Gopika Gopakumar.
So negative news coming in there from rating agency Fitch. Joining us now to discuss the implications of both the Fitch downgrade as well as the Reserve Bank status quo policy is the President of the Confederation of Indian Industry, GODREJ. Also with us, Vice Chairman and CEO of HDFC, KEKI MISTRY, and the former RBI Deputy Governor, RAKESH. Mohan, gentlemen, appreciate you joining us here on India Business Hour. Mr. Mohan, over to you first. Do you understand the disappointment that is being expressed by industry? We also have the Commerce Minister Anand Sharma saying that he will write to both the Finance Minister as well as the Reserve Bank saying that this was clearly disappointing news from the Reserve Bank. But this argument that both the government and industry seem to be making, that the investment cycle is in a sense a function of interest rates, and the Reserve Bank is hitting right back and saying that investment cycle is not merely a function of Indian rates, the interest rates. Do you believe the logic that industry is giving and the explanation from the Reserve Bank?
Well, one of the somewhat distressing things that has happened in the last few years is it seems that the belief both in industry as well as possibly in the government that investment and interest rates are really like a hydraulic system where you suddenly increase you suddenly decrease the policy interest rate from the central bank, and somehow interest rates will automatically shoot down in the economy, and therefore industry will start gaining. The economy is a much more complex mechanism, which I thought we used to understand much better. Consumer price inflation is of the order around 10% plus. That is clearly very difficult for banks to reduce deposit rates. Second, given the large fiscal deficit of the government, hence large market borrowing program, that the medium and long-term interest rates are clearly being determined by this large borrowing programs.
So you understand the Reserve Bank's predicament. Mr. Mistry, over to you. It's a status quo policy, but a lot of people seem to believe, as Mr. Mohan was saying, that this is the most prudent thing for the Reserve Bank to have done. Looking where the inflation numbers are, it gives the Reserve Bank enough reason to be anxious. We've just got the CPI number for May coming in today at 10.36%. So can you really blame the Reserve Bank for delivering a status quo policy?
I don't think one can blame RBI for delivering a status quo policy. One would have liked to see some reduction in CRR more than a reduction in interest rates, because liquidity in the system is a little tight, running at around 75 to 80,000 crores negative. So if that could come down to around 40, 45, 50,000, it will be a big boost to confidence. But having said that, one can fully appreciate RBI's position, because all this while RBI has been focusing on inflation. Inflation numbers have not come down, are unlikely to come down in a hurry for a variety of reasons which we talked about before. One is supply side constraints, and the other, which I mentioned recently, was the currency. You take the instance of March and June. In March, oil prices were $120 a barrel and rupee was 48. Today oil prices have come down to 97, 98 dollars a barrel, and the rupee has depreciated, not appreciated. So we are not getting the advantage of falling commodity prices globally because of a weak currency.
Okay, Mr. GODREJ, let me come to you now, because industry is clearly disappointed with the fact that the Reserve Bank has decided not to move on either CRR or repo. But the Reserve Bank's argument is that the investment cycle is not merely a function of what it does on interest rates. It has to worry about inflation. Inflation is raging at over 10%. At least that's the CPI number that we're dealing with this afternoon. There was no choice for the Reserve Bank but to not move on rates.
No, I don't agree with that interpretation. I think the WPI is only around 7% and inflation has come down. Most importantly, inflationary expectations are down because global commodity prices are coming down, especially crude oil. And we are very disappointed that RBI has not lowered the interest rate or the CRR, because the lack of funding, especially for small and medium enterprises, and the high interest rates are clearly coming in the way of investment and therefore production and GDP growth. And we have mentioned this.
Okay, industry clearly disappointed, Mr. Mohan. You know, while we're hopeful that some of these things like capping of oil subsidies, perhaps partial deregulation of diesel, etc., will happen, they may perhaps move on other crucial pending reforms as well. We heard from Kaushik Basu saying that they could perhaps move on things like FDI and retail. But if that wasn't to be the case, and if inflation numbers expected in the month of July were to look as ugly as the ones that we were served with today, do you think the possibility of the Reserve Bank cutting rates on the 31st of July is pretty much ruled out?
Well, given what the governor has stated this morning, that would be logical. But I would still again further add that there is excessive importance being given to such rate actions by the Reserve Bank, that if the other actions are not taken, even if the governor takes such actions, as he did indeed in April, there will be no effect on interest rates.
Okay, excessive importance being given to rate action. But KEKI, MISTRY, back to you. As far as liquidity is concerned, do you take heart from the commentary that's coming from the Reserve Bank, which says that they will use the OMO window and other appropriate instruments as and when required, pretty much going out there and saying that liquidity continues to be an issue that we will manage?
No, I think that would be very positive. If they continue with the OMO program, if enough liquidity is injected in the system, that is all that is going to enable our banks to cut rates. A mere interest rate cut by RBI would not really have helped banks in cutting interest rates on their own loans, because at the end of the day there is a limited amount that we borrow from RBI. But enough liquidity in the system will enable them to cut deposit rates, and that would enable them to pass the benefit back to borrowers by reducing lending rates. So through OMO operations, if liquidity can be injected in the system, I think it will be very, very positive.
Right, but if you look at the Reserve Bank's argument, it says that it front-loaded rate action. It gave you 50 basis points when no one expected it in April, and even that wasn't passed through by the banking system. So would 25 basis points really have changed the world for you?
It's not a question of changing the world. Shireen, the present position India needs to be corrected, reforms need to be brought in, interest rates need to be brought down, and most importantly CRR should have come down. If the banks are not cutting interest rates, the CRR should be reduced.
Right, you're saying CRR should be reduced, but you know, Rakesh Mohan, let me come back to you. What about the possibility of another stimulus? QE3 is being talked about in the US at this point in time. The Reserve Bank has alluded to the fact that pressures offer further stimulus in the global economy could mean commodity prices moving up, and that could reignite inflationary pressures across the world and transport those to India. How significant is the possibility of another stimulus likely to impact our policy on the 31st of July?
Well, I think this is actually a much broader issue. That one, of course, is what you mentioned, the possible QE3 in the United States. Second, I think much more important is really what happens in Europe post the Greek election and the resolution or otherwise of the Spain crisis and perhaps possibly an Italian crisis. So I think that the governor would be well advised over the next few weeks to really keep his eyes and ears open on what happens both in Europe and the United States. If difficulties do arise as a result of these issues that I just mentioned, both in Europe and the US, that we are able to manage our economy with appropriate liquidity in the system to at least achieve the kind of growth rates that are currently being expected. So I think the governor really has to be focused on these issues rather than the rate cut issue, which I think is to some extent the current circumstances not that important in terms of its medium-term effect, even short-term effect on what actually happens to interest rates and investment in the economy.
So crucial to keep an eye on what's happening globally. But Mr. MISTRY, it's clearly a wait-and-watch policy at this point in time. Do you anticipate now that the Reserve Bank will move when it announces its policy 6 weeks later? Or do you believe if the inflation numbers continue to look bad, it's pretty much over and done with even on the 31st of July?
See, I don't think you should be looking only at food inflation, because people's food habits are not going to change whether interest rates are high or low. You need to look at inflation outside of food. You need to look at commodity prices. You need to look at core inflation. Those are far more relevant issues than food inflation. So at the beginning of the year, we always said that we believed that during the course of the year, RBI would be able to cut interest rates by about 100 basis points. out of that 100 basis points, they've gone and already cut 50 basis points in April itself. So that remaining 50 basis points cut in interest rates is still very much on the cards. So I do believe that as you get into the second half of the financial year, you will start seeing some action on the part of RBI. Hopefully, if core inflation numbers start looking lower, hopefully if the currency starts looking a little stronger than what it has been.